Welcome to the Deep Dive.
Hello.
Today we're doing something pretty specific. We're not just talking about India in general terms.
Right.
We're diving deep into the analysis of a major firm's strategic playbook for the Indian equity market. Think of it like pulling back the curtain on what a leading investment house is telling its clients, its internal teams right now.
Exactly.
Yeah.
And the source material here, it's not just news reports. It's specifically a detailed breakdown of that firm's own in-depth report. So our mission today is really to go beyond just a summary, to truly extract the most important nuggets, maybe the surprising insights, the core arguments, perhaps even the hidden assumptions.
That's it. We're going to look at the big picture economic view that kind of sets the stage. Then the specific equity market strategy they recommend. And, really importantly, the key charts they use to tell that story.
Right, the visuals.
And because this is a deep dive, we'll definitely chew over the strengths, the weaknesses, and yeah, those crucial assumptions baked into this whole thesis.
You have to.
By the end, you're going to walk away understanding the core case for India, according to this particular view, the specific opportunities they pinpoint, and the risks you absolutely need to have on your radar. Okay.
Yeah.
Let's get into it.
Let's do it. So this analysis we're unpacking, it structures its view using two primary lenses, basically.
Okay.
First, you've got the economist's lens that's focused on the macro story, the big picture.
Right.
And second, the research analyst's lens, which translates that macro picture into an actual equity strategy, what to buy, what to sell.
Makes sense. Let's start with that first one, then the economist view, the macro landscape. What's the absolute central argument here? What's anchoring this whole report?
Well, the core idea is positioning India as this distinct pocket of strong macro stability. And they specifically contrast that with what they call a world of global uncertainty.
Okay, stability in an uncertain world, that sounds good, but it's a big claim. Where do they actually see that stability coming from? What are the specifics?
They point to a few key things. Improving terms of trade, a declining primary deficit, which, for anyone wondering, that's the government deficit before you even account for interest payments. So seeing that fall is a sign of improving fundamental fiscal health.
Got it. Core health improving.
Exactly. And critically, low inflation volatility. They argue this predictability in these key economic areas creates a stable backdrop, though they do add a little caveat: patience is needed to see the full benefits play out.
Patience noted. Okay, what about growth?
Right.
Because stability is great, but for equities, you really need growth, right? What's the forecast look like?
Yeah, the forecast is for steady, pretty respectable real GDP growth. They're projecting 6.3% for the current fiscal year, F2025.
Okay.
Then nudging up slightly to 6.5% for F2026 and F2027.
So consistent growth.
Right. They do acknowledge there's been a recent slowdown, but their read on it is that the market has kind of already factored that in. The real insight, I think, is what they believe will drive growth going forward.
Okay, and what are those specific drivers they're banking on? What's supposed to pick up the slack?
They highlight two key things they see emerging right now. First, an uptick in private capital expenditure, or CapEx. So business is actually investing, building things.
Right, not just government spending.
Exactly. And second, what they call a structural rise in discretionary consumption. So think, urban demand starting to recover, people feeling a bit more confident, spending on non-essentials again.
That private CapEx piece feels really important. Government CapEx has been the story for a while, but private sector joining in, that's a different stage, isn't it?
It is. It's crucial for the next leg.
Okay. What are we talking?
Yeah, they see this as a major strength for India right now. The report talks about declining volatility in inflation and lower headline inflation. The average CPI forecast is actually quite benign.
Okay.
4.9% for F2025, and then cooling further to 4.3% over the next 2 years.
4.3. And when inflation is moderating like that, becoming less jumpy, what does that usually imply for the central bank, for the RBI?
Well, exactly. It points towards a more dovish outlook for the Reserve Bank of India. Their base case actually assumes further rate cuts are coming.
Okay, how much?
Specifically, they anticipate a 50 basis point reduction in short-term rates. The projection is for the repo rate to end F2025 at 6.3% and then drop down to 5.8% by the end of F2026. That's a really key assumption underpinning their market outlook.
50 basis points.
Right.
Right, so stable inflation potentially gives the RBI room to ease policy. That's generally helpful for risk assets. like stocks.
Definitely.
We touched on the primary deficit earlier. What's the overall view on India's fiscal health in this report?
It's viewed very positively. That declining primary deficit is framed as a key part of the whole macro stability story, and the market outlook's base case firmly relies on continued fiscal consolidation by the government. They even call out a specific chart showing this falling primary deficit relative to GDP, making it visual.
So the domestic picture looks pretty solid according to this analysis, right? Stable government finances, manageable inflation, maybe a helpful RBI, and these domestic growth drivers starting to kick in. But, India doesn't exist in a vacuum. What about the external side, global linkages?
Good point. They see the currency and the external sector as stable, too. The current account deficit, the CAD, is projected to remain very manageable, just minus 0.7% of GDP in F2025.
Okay, that's quite low.
Yeah, rising only slightly to minus 1.0% by F2027. Pretty contained compared to some past cycles.
So what external factors do they say are really critical to watch? Where are the vulnerabilities?
Interestingly, they actually flag global linkages as the most critical variable for their entire thesis. The whole base case kind of hangs on a specific global scenario playing out.
Which is?
Slow growth in the U.S., but no recession. That's key, coupled with benign oil prices.
The usual suspects, oil in the U.S.
Always. The explicitly mentioned global risks are, well, a U.S. recession, obviously, surging oil prices, deflationary pressures coming out of China, and, broader geopolitical events.
Makes sense. Oil is always huge for India, and what happens in the U.S. affects everyone.
I think I saw something interesting in the analysis about India's sensitivity, its beta, to global markets.
Yes, that's a fascinating point they emphasize.
Hold on.
They argue that because India's beta relative to world equities is low,
Yeah.
and importantly, it's falling.
Falling.
Yeah, falling, meaning its market movements are becoming less correlated with global swings over time. Because of this, they argue India is actually positioned to potentially outperform in a global bear market
Okay.
and maybe underperform in a roaring global bull market. It's quite counterintuitive, maybe,
Yeah.
but it's central to their diversification argument for holding India.
That low and falling beta is a really interesting angle for portfolio construction, isn't it? Less correlated returns.
Absolutely.
And any mention of structural reforms, anything on the policy front that could add fuel. It's not the main focus, but yeah, potential for more reforms is definitely cited as an upside catalyst. Their more optimistic bull case scenario specifically builds in the potential impact of a slew of GST rate cuts and maybe some progress on farm laws. So policy action could provide some extra steam.
Okay, that gives us a good handle on the economist's foundational view. Stable macro, steady growth, predictable inflation letting the RBI potentially ease, manageable external accounts. But with global health being the absolute key variable, the big if.
That sums it up well.
Right. Now let's shift gears. Let's look for that second lens, the research analyst perspective. How does this macro picture translate into a view on the actual stock market? What should investors do?
Okay, so this is where they get specific about the equity market itself. The research analyst's view is definitely bullish, but they are very clear it's a selective bull market, not just buy everything.
Elective bull market. Got it. And what's the headline finding on valuation? Is India cheap, expensive?
The headline is pretty punchy. Equities appear inexpensive.
Ooh, that certainly gets your attention. On what basis are they saying that?
Well, it's not just a simple PE ratio comparison, though they do look at that. They look at how the market's derated compared to other assets like bonds and gold. But a key insight, and maybe a fresher perspective, is comparing India's share of global GDP, which has risen structurally over time.
Right. India's economic weight has grown.
Exactly. Comparing that to its share of world market capitalization, which they argue has lagged behind. This gap, this difference, suggests there's potential for the market to re-rate, both globally and domestically. That's why they see it as inexpensive on this kind of relative structural basis.
That makes sense. If the economy is a bigger piece of the global pie, maybe the stock market should be too, eventually. So what are the actual quantitative targets they've put out there? What numbers are we talking?
Okay, the core quantitative conclusion is their base case target for the BSE Sensex, 89,000 by June 2026.
89,000. And what kind of upside was that from when the report came out?
At the time, that represented about a 9% upside. They also map out a bull case that's 100,000 on the Sensex, offering 23% upside, and a bear case down at 70,000, which implies about a minus 14% downside. So you can clearly see the potential risk-reward profile as they model it.
Right, asymmetric upside in the base and bull. And what kind of valuation multiple does that 89,000 target imply? Are we talking historically expensive levels?
It implies a trailing price-to-earnings, or PE, ratio of 23.5 times. Now, that is a premium compared to India's long-term, say, 25-year average PE of around 21 times.
Okay, so a bit higher than average. How do they justify that?
They do justify it explicitly. They point to higher confidence in India's domestic growth cycle now, the predictability they see in policy that we talked about, and that lower falling market beta. Those factors, they argue, warrant a higher multiple today compared to the historical average. It's essentially a bet on improved quality and predictability of growth.
Got it. And for that kind of multiple to hold up, let alone expand, you really need strong earnings growth coming through. What's the forecast on the earnings side?
Yeah, absolutely critical. And the forecast is described as quite strong. They project Sensex earnings per share, EPS, growth at 14.7% for F 2025.
Okay, mid-teens.
And then accelerating to a pretty robust 19.1% in F 2026. The overall forecast is for, and I quote, mid to high teens earnings growth annually over the next 3 to 5 years. That's a key pillar supporting both their targets and that premium multiple justification.
Mid to high teens earnings growth consistently. That's definitely a powerful driver if it pans out. So translating all of this, the macro stability, the emerging growth drivers, the earnings outlook, the valuation view into an actionable strategy, what are the key investment themes they recommend focusing on? Where should people put their money?
Right. The strategy has a very distinct tilt towards domestic-facing stories. They're actively avoiding areas exposed to global cycles or purely defensive sectors. They highlight 3 main themes. First, the private capex cycle. They see this emerging now, building on the strong government capex that's already been happening. This is about companies starting to invest in their own capacity again, building factories, buying machinery.
Right, the build-out story.
Exactly. Second, consumption recovery, specifically that structural rise in discretionary consumption we mentioned, betting on urban demand coming back strong, driving sales of goods and services beyond just the absolute necessities.
The confident consumer.
Precisely. And third, financialization. This theme is supported by a couple of things. Companies starting to re-leverage their balance sheets, feeling comfortable, taking on a bit more debt to invest, and strong overall credit growth across the economy. That underpins a positive view on the financial sector. Banks, NBFCs, etc.
So leaning hard into those India-specific growth stories, building things, spending money, and financing and all. Given those themes, what's the concrete sectoral strategy?
Yeah.
Which specific sectors are they telling clients to be overweight in?
There's a very clear cyclical tilt here. They recommend being overweight financials, consumer discretionary, and industrials.
Okay. Any particular weighting?
Yes. Financials are a plus 300 basis point overweight compared to the benchmark. Consumer discretionary also plus 300 basis points. And industrials is actually their strongest conviction call at a plus 400 basis point overweight.
Wow, strong call on industrials.
Yeah. The logic is explicit. Actively avoid defensive sectors and favor these domestic cyclical areas over the global ones.
And funding those big overweights means you have to be underweight somewhere else. Which sectors are getting the chop?
Right. They recommend being underweight energy that's minus 200 basis points, materials minus 300, utilities minus 100, and healthcare minus 200 basis points. It aligns perfectly with avoiding those global commodity plays and the traditional defensives, reinforcing that focus on the domestic cycle.
Very clear positioning. And do they express a preference for large companies versus smaller ones? Large caps, mid caps, small caps?
Interestingly, no. They explicitly state it's going to be a stock pickers market, and they say they are capitalization agnostic.
Agnostic.
Yeah. So it's less about the absolute size of the company and more about finding the right individual names that really benefit from those key domestic themes, the capex, the consumption, regardless of whether they happen to be big blue chips or nimbler mid-caps.
Stock picking matters more than size.
Okay.
Let's talk about the market dynamics themselves for a second, because the analysis highlights what sounds like a really significant shift in who is actually participating in the Indian market these days.
This is, I would argue, possibly one of the most important structural points in the entire report. They put a huge emphasis on the dramatic rise of domestic capital.
Local money.
Exactly. Retail flows, everyday Indian investors putting money into the market, often through things like SIPs, the systematic investment plans. They're now seen as a reliable source of domestic risk capital. And crucially, these flows have shown resilience. They've held up even during past market sell-offs.
Right. And this huge rise in domestic participation is happening while what's happening with foreign investors.
That's the other side of the coin. It's happening while, and this is a direct quote, foreign portfolios positioning is the weakest since 2000.
Wow, weakest since 2000. That's a huge shift, isn't it?
It's massive. Historically, foreign institutional investors, FIIs, were often seen as the marginal buyers or sellers dictating market swings. Now, this analysis argues domestic money provides a significant growing cushion. It's changing the market's internal dynamics. They don't just see this as a temporary flow observation, they frame it as a fundamental structural change supporting market stability.
That fundamental shift in market ownership, from foreign dominance to domestic resilience.
Mm-hmm.
Yeah, that really does feel like a potential game changer for how the market behaves.
It could be.
Okay. Beyond the big macro risks we talked about, U.S. recession, oil prices, are there any market-specific risks they flag? Things internal to the Indian market itself?
Yes, they do mention one specifically. The potential for a bunching of issuances of new equity.
A bunching of issuances,
Mhm.
meaning
Meaning if too many companies try to come to the market to raise fresh capital through IPOs or follow-on offerings all at the same time.
too much supply.
Exactly. It could potentially overwhelm or at least challenge that strong domestic retail bid that they're relying on as a stabilizing force. Supply overwhelming demand, basically.
Got it. Okay, so we've laid out the macro foundation, the equity strategy, the sector tilts, the valuation case, and that crucial shift in market flows towards domestic investors. The analysis also focuses quite a bit on how this complex story is told, specifically highlighting 5 critical charts. These aren't just data points. They're central to visually conveying the core arguments.
Absolutely. These visuals are designed to underpin the key insights and make them stick. The first critical one they identify is titled Share and Gain in World Market Cap Gain in Global GDP.
Okay, share in world market cap, less than gain in global GDP. Why is that chart so important to their story?
Because it's the visual proof behind that equities appear inexpensive call, but on a global scale. It shows how India's economic growth, its share of the gain in global GDP over time, has structurally outpaced the growth of its stock market's value relative to the rest of the world.
So the economy grew faster than the market cap, globally speaking.
Precisely. It visually screams, hey, there's a potential re-rating opportunity here. It helps answer that fundamental question for global investors, why India and why now, by showing this potential catch-up gap.
Got it. The potential value gap shown visually. Makes sense. What's the second key chart they highlight?
The second one is the BSE Sensex Outlook, risk-reward for June 2026. This one's crucial because it's the direct quantitative outcome of their entire analysis. It literally plots their 89,000 base case target right there, alongside the bull scenario, 100K, and the bear scenario, 70K. It makes the potential upside and downside really tangible and easy to grasp for an investor looking at the numbers.
So you can immediately see the potential return profile they're forecasting. Straightforward. Chart number 3.
Chart 3 is India's beta relative to world equities is low and falling.
The beta chart we discussed.
Exactly. This chart provides pure visual support for that really interesting point. You see the line clearly slipping downwards over time, showing how India's stock market is becoming less correlated with global market movements. It's the visual argument for India potentially acting as a less volatile, more independent market, maybe even offering some defensive characteristics in a global downturn, despite being an emerging market.
Yeah, seeing that decreasing beta trend line is a powerful visual for anyone thinking about portfolio diversification. What's chart 4?
Chart 4 is titled New Investment Projects RSBN 4Q Trailing Sum. This one is critical because it provides concrete, fairly up-to-date visual evidence for that private CapEx recovery theme we keep talking about.
How does it show that?
It shows the trend of new investment project announcements, broken down by source government sector versus private sector. And what you see, particularly in the recent data points on the chart, is a sharp uptick specifically in private sector announcements. That's the surging green bar they often highlight. It makes the CapEx story feel real, like it's happening now.
Right. Seeing that green bar jump is probably quite convincing for investors looking for tangible signs of that physical economy pickup. Powerful. And the 5th critical chart.
The 5th one is domestic exceeds foreign ownership. This chart directly illustrates that fundamental structural shift in market dynamics we discussed earlier.
The flows story again.
Exactly. It visually shows the lines crossing and then widening the share of market ownership held by domestic investors, decisively overtaking the share held by foreign investors. It's probably the most direct visual evidence supporting the argument about the rising influence of local money as a source of market stability and maybe a valuation cushion.
Those 5 charts really do seem to capture the core pillars of the argument, don't they? They give you the data behind the narrative.
They're chosen very deliberately for that reason.
Okay, so we've covered the substance, the macro view, the strategy recommendations, the key visuals backing it up. The analysis we're drawing from then shifts focus a bit, looking at how this complex message gets tailored for different audiences. Specifically, how do they synthesize all this for an internal team discussion versus how they communicate it externally to clients?
Right, and that's an important distinction. The internal discussion is going to be, naturally, much more detailed. It's about laying bare the full rationale, the nuances, the potential disagreements, and critically, the weaknesses in their own thesis.
Okay, so what kind of things would be discussed internally that might get, let's say, glossed over or simplified when talking to clients?
Well, for the internal team, they'd get a full executive summary, hitting all the key points we've covered, the overall bullish stance, why they see value in expensive, the macro stability buffer, the specific sector tilts, OW fin ind disc, UW def global cyclicals, how that Sensex target is explicitly tied to global assumptions like a soft U.S. landing and benign oil, and the whole stock picker's market idea.
Standard recap.
Yes, but crucially, the internal discussion would also dissect the strengths and the weaknesses of the report's own thesis. They'd critique themselves.
Okay, self-critique is important. So what weaknesses did this analysis identify in the report's view, looking inward?
The analysis points out that the base case relies pretty heavily on what you might call a Goldilocks global scenario that's slow U.S. growth, but definitely no recession. This is flagged internally as a potential vulnerability. The report might be understating the potential contagion effect of a serious global recession, even with that low beta argument.
Right, the beta might not hold up in a real panic.
Possibly. Another potential weakness identified internally was the capitalization agnostic stance. After all the recent concerns about froth and smaller caps, just say agnostic might have felt a bit non-committal or dodging the issue to some internally.
Okay. And are there specific points the internal team might debate or really question amongst themselves?
Oh, absolutely. That's kind of the point of the internal deep dive, right? To pressure test the ideas. Debatable points would likely include, is that private CapEx pickup really robust and sustainable yet? Or is it still tentative? How sticky are those domestic retail flows, specifically in a prolonged, painful market downturn? We haven't really seen that tested structurally.
Good question.
And is the forecast for such low CPI maybe a bit too optimistic? If inflation proves stickier, that could challenge the whole assumption of a dovish RBI having lots of room for rate cuts.
Right, the RBI's hands could be tied.
Exactly. They'd also dive much deeper into the rationale for each sector call, maybe debate specific stock inclusions or exclusions, and identify clear research gaps, areas where they realize they need to do more work. Maybe build a more rigorous framework for predicting retail SIP stickiness, or dig deeper into the balance sheets of mid-cap industrial companies to see which ones are truly ready and able to invest in CapEx.
And I assume a detailed risk matrix is absolutely essential for internal planning, not just the headline risks.
Oh, yes, absolutely. The internal view includes a comprehensive risk matrix, listing key risks very explicitly. Global macro stuff, like a U.S. recession or maybe just a sharper than expected slowdown. Commodities, especially a big oil price spike. Monetary policy risk, what if the RBI has to tighten instead of cutting? Geopolitics, of course. And market flows, like that risk of issuance bunching we mentioned. And importantly, they discuss potential mitigation strategies or key indicators to monitor closely for each of those risks.
Very thorough. And alternative scenarios. What if the whole base case is just plain wrong?
Yeah, this is key for internal contingency planning. They'd look beyond just the main published bear case. For example, scenario 1. Global stagflation. You get sticky inflation globally combined with sluggish growth. That would directly challenge the dovish RBI assumption and might mean defensive stocks or maybe even tech outperform the cyclicals they're recommending.
Right, flips the script.
Or scenario 2, what if China rebounds sharply? Maybe driven by aggressive government stimulus. That would likely give a big boost to global cyclicals like energy and materials, precisely the sectors they are currently underweight in their base case. Thinking through these alternative worlds forces the team to consider how their positioning would hold up if the future looks very different.
Okay, so that gives us a sense of the level of depth, the detail, and the self-criticism involved in the internal discussion. How does all of that complexity get simplified and framed when communicating it externally to clients?
Yeah, the focus shifts significantly. For clients, it's much more about crafting a compelling, clear narrative. India is positioned as maybe a beacon of stability and opportunity in that uncertain global context you mentioned.
More storytelling.
Exactly. The key message is streamlined. Stocks look inexpensive, supported by the strong domestic economy, moderating inflation, and crucially, that resilient local investment base. It's framed more as a long-term investment story, anchored by India's domestic future, less about the immediate global wobble.
And those key investment themes, capex, consumption, how are they presented to clients? Probably not just as bullet points.
Right. They're often packaged into easily understandable narratives, maybe the top 2 or 3 most compelling ones. You might hear phrases like the Great Indian Build-Out to capture the whole capex cycle story, government leading, private sector stepping up, creating this multi-year opportunity for industrials and manufacturing-related companies. Or perhaps the confident Indian consumer, highlighting rising incomes, the shift towards spending on discretionary items as a structural trend, and focusing on companies set to benefit from that.
Okay. And what are the actionable takeaways for a client hearing this? What are they supposed to do?
The strategic implications are framed very much around what it means for their portfolio. The advice is usually to maintain a constructive view on India, but with an emphasis on the need for careful stock selection. They'd recommend tilting exposure towards those domestic growth beneficiaries, the favored industrials, financials, and perhaps select consumer brands. They'd also likely position it in terms of different client risk profiles.
How so?
Well, for growth-oriented investors, it's a signal about participating in the cyclical recovery. For more conservative investors, they might highlight that low global sensitivity, the falling beta, as offering a degree of reassurance while still being mindful of the risks, of course.
And do they typically mention specific company names to clients to make it more concrete?
Yes, the analysis notes that the client-facing report often includes specific, recognizable company examples drawn from their focus list. It helps make the themes less abstract. So you might see names like Larsen and Toubro mentioned for industrials, ICICI Bank or Bajaj Finance for financials, maybe Maruti Suzuki or Jubilant FoodWorks for the consumer discretionary theme, just as examples cited in this type of analysis.
Got it. And how are the risks communicated to clients compared to that detailed internal matrix we talked about? Must be simpler.
Much simply. It's usually boiled down to a concise list, typically the top 3 or so key risks to monitor. Based on this analysis, for clients, it would likely be things like 1. A significant spike in global oil prices. 2. A sharper than expected economic slowdown in the U.S. And 3. Unexpected changes in the pace or direction of RBI interest rate movements. Much shorter, much higher level than the exhaustive internal list. And the visual storytelling, the charts, are also carefully curated for the client audience. They'd focus on the most impactful charts, the ones that are simple but powerful, like that share in world market cap versus global GDP chart.
The valuation gap one.
Exactly, because it instantly explains that global valuation rationale. Or the new investment projects chart, particularly highlighting that surging green bar showing private investment picking up that's tangible proof of the build-out theme. They choose visuals that strongly support the core narrative in an easy-to-digest way.
Makes sense. And presumably, it all wraps up with a clear call to action for the client.
Precisely. The end goal is to move the client from just understanding the view to actually doing something. So they typically recommend reviewing their current portfolio exposure to this India domestic growth story and, naturally, suggest scheduling a follow-up meeting to discuss specific positioning tailored to the client's individual situation and goals.
Okay, perfect. We've really dissected the report's argument now, from the macro foundations down to the specific stock strategy. We've seen how the story is told with data and how it gets packaged differently for internal teams versus external clients. But the analysis we're drawing from today goes one crucial step further. It critically evaluates the report itself. It doesn't just accept it at face value.
And this critical evaluation piece is, I think, really crucial for getting a balanced perspective. The first thing it does is try to identify the absolute bedrock assumptions that this entire detailed playbook is built upon. What has to be true for this outlook to hold?
Right. What did the analysis pinpoint as those core underlying assumptions?
It identifies 3 really critical ones. First, a global soft landing. This is the big one. The base case explicitly requires the U.S. economy to avoid a recession. The analysis flags this assumption as the major vulnerability of the entire thesis. If that's wrong, a lot of the argument weakens.
Okay, that's a huge dependency. What's the second critical assumption?
Second, the idea of structural domestic flows. The report assumes that the recent surge we've seen in Indian retail investment isn't just a temporary, perhaps stimulus-fueled trend. It assumes it's a permanent structural shift, one that will reliably cushion the market and support valuations even through a prolonged bear phase. That's an assumption that hasn't really been stress tested in a deep, sustained downturn yet.
Right. The resilience is assumed, but not fully proven long-term.
Yeah.
And the third assumption.
Third is a benign policy environment. It assumes that the stable, predictable government and RBI policy environment we've seen recently, including things like continued fiscal discipline from the government and that dovish stance from the RBI, will continue more or less uninterrupted. Political stability, policy continuity.
Okay. So global soft landing, sticky domestic flows, and stable policy. If any of those three pillars wobble significantly, the whole structure of the argument is challenged. What about bias? Does the analysis detect any specific leanings or slants in the report itself?
Yes, it does. It points out what it sees as a clear, pro-cyclical, and generally bullish bias throughout the report. The title itself, equities appear inexpensive, kind of sets that positive tone right from the start. And while risks and a bear case are definitely presented, the analysis suggests the narrative weight, the emphasis, is clearly skewed towards the positive base and bull scenarios.
Understandable, perhaps, given the conclusions, but important to note the bias. Given those assumptions and that potential bullish lean, what's identified as the absolute primary risk, the single biggest thing that could completely derail this entire positive thesis?
The analysis is pretty clear on this. A global hard landing.
Back to the global picture.
Exactly. If the U.S. and Europe experience a significant sharp recession, the resulting collapse in global demand and the widespread flight from risk would likely be powerful enough to overwhelm even India's low beta characteristics and its domestic strengths. In that scenario, you'd almost certainly see broad-based earnings downgrades and market derating across most sectors in India, regardless of how strong the domestic themes might seem in isolation. Global fear can trump local fundamentals.
Right, a global storm hitting all shores. Are there any pieces of the puzzle that the analysis felt were kind of missing or perhaps not explored deeply enough in the original report?
It suggests a couple of areas. One is that the report could perhaps have given more weight to potential social and political risks within India, things like the outcome of future state and general elections, and how significantly that might impact policy continuity or the momentum for further reforms. That political variable might be underplayed.
Okay, domestic political risk. Anything else?
Also, while a historical terror attack was mentioned in the context of something the market had previously digested, the analysis suggests the tail risk of a major, unforeseen geopolitical flare-up in India's immediate region might also be somewhat underplayed, given the potential massive negative impact it could have.
Fair point. Okay, finally, looking at the analyst who evaluated this report, the one whose perspective we're channeling today, what's their overall confidence level in the report's thesis? Do they buy it completely?
They actually split their confidence level, which is interesting. They express high confidence in the long-term structural story being presented.
The big picture stuff.
Right. The rise of domestic flows, India's increasing importance in the global economy, the potential for a multi-year capex cycle, they find that long-term narrative compelling. But they express only medium confidence in the more tactical 12 to 18-month view and that specific 89,000 Sensex target.
Medium confidence on the target. Why the lower conviction there?
Precisely because that shorter-term tactical outlook relies so heavily on those inherently uncertain global outcomes we keep coming back to, especially the U.S. avoiding recession and oil prices staying calm. So the overall take is that the analysis within the report is thorough and well-argued, but the base case scenario it ultimately presents is viewed as perhaps optimistic, given the global dependencies.
Wow. Okay. That's a really comprehensive breakdown. So stepping back, what have we really distilled from this deep dive into one major firm's India playbook?
I think we've seen clearly how a major investment house builds a compelling case for India right now. They frame it as a place of relative domestic stability and significant growth potential, particularly seeing value in the market compared to global peers. Their strategy is very clearly rooted in those India-specific themes, building infrastructure, increasing consumer spending, and it's powered by that crucial, potentially game-changing wave of domestic investment.
Yeah, that domestic flow story is huge. But importantly, we haven't just accepted that narrative at face value today, have we?
Not at all. We've dug into the core assumptions underpinning it, all those big ifs about global stability, the stickiness of domestic flows, and predictable policy. And we've identified the specific risks, both global and domestic, that could seriously challenge this entire positive view.
Understanding all those different layers, the foundational macro view, the resulting equity strategy, the specific data points used to illustrate it, the detailed internal debates and contingency plans, how the message gets simplified for clients, and then finally, that critical evaluation of thesis's own assumptions and vulnerabilities. It gives you, the listener, a far richer, more nuanced perspective than you'd ever get from just reading a market commentary headline.
Absolutely. It's the difference between just seeing the recommendation and actually understanding the thinking, the debates, and the risks behind the recommendation.
Exactly. And maybe here's a final thought to leave you with, something to chew on. If this report's core analysis is correct, if domestic capital is now a truly structural resilient cushion for the Indian market, in a way it never was before, does that fundamentally alter how investors like you should approach risk and opportunity in India compared to all the previous market cycles that were primarily driven, and often whipsawed, by foreign investor sentiment? That feels like a potentially profound shift in market dynamics to consider.